Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with an up-to-date overview of Kenya's financial markets. However, due to the interconnected nature of the global economy, we have structured this podcast to begin with an overview of the global markets so as to provide you with a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the major markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. This podcast is targeted at the individual with an interest in the financial market, but who probably doesn't have the time for research and analysis. That's why I created the Market Color Podcast to collate and analyze the data on your behalf and to present it in a brief and concise manner that is easy for you to consume. This podcast may also be useful to fund managers and investors, professionals in the financial services sector, business owners and leaders, as well as Kenyans in the diaspora looking for investment opportunities back at home. This week, we are reviewing the performance of the Kenyan markets during the 40th week of 2022. That is from Monday the 3rd to Friday the 7th of October. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick off the podcast in the US, where on Friday, the US Labor Department reported that non-farm payrolls increased by 263,000 jobs for the month of September. This was a significant deceleration from the 315,000 jobs that were created in the month of August. However, despite efforts by the Federal Reserve to slow down the overheating economy, the unemployment rate declined from 3.7% to 3.5% as the labor force participation rate also edged lower to 62.3%. The September jobs report has provided confirmation that the U.S. economy remains strong and therefore the Fed Reserve will need to do much more to contain consumer demand, which continues to drive up inflation. The jobs report was a clear message to the markets that more interest rate hikes are on the way. In the US stock market, what started out as a comeback week for stocks reversed course on Friday as stocks fell across the board on the back of the September jobs report, which sparked an increase in interest rates. The Dow Jones Industrial Average fell 630 points to 29,296, while the S&P 500 lost 2.8% to 3,639, and the Nasdaq Composite also slid 3.8% to 10,652. Despite the dip on Friday, the major averages still closed the week higher, with the Dow Jones rising 2% for the week, while the S&P added 1.5% and the Nasdaq ticked up by just 0.7%. In the U.S. bond market, the yield on U.S. Treasury bonds rose on Friday as investors digested the September jobs report and its implication on inflation and the Fed Reserve's monetary policy. The benchmark 10-year Treasury note added 6 basis points to 3.883%, and this was after surpassing the 4% level the previous week. The yield on the policy-sensitive 2-year note also rose 6 basis points to 4.31%. The U.S. Treasury yield curve remains inverted, with the 2-year rate being higher than the 10-year, which is considered an indication of an upcoming recession. Investors have been worried about the Fed hiking rates too quickly, which could cause the U.S. economy to slide into a recession. On the currency front, the US dollar strengthened against other major currencies on Friday after the latest jobs report suggested that the Fed Reserve will stick to its aggressive tightening policy. The dollar was up 0.2% against the Japanese yen at 145.42 and was hovering just below a 24-year peak of 145.90, which was hit last month and prompted an intervention by Japanese authorities. The euro fell against the dollar and was last down 0.6% at 0.9735 US dollars. Sterling was no exception and dipped 0.9% versus the dollar to trade at 1.1060 US dollars. The dollar also gained against the offshore Chinese yuan and was last up 0.7% at 7.13 Chinese yuan. The US dollar index, which measures the greenback against a basket of 6 currencies, is up about 18% so far this year. In the commodity markets, the price of crude oil rose 3% to a 5-week peak, driven higher by an OPEC Plus decision to effect its largest supply cut since 2020. The supply cut from the Organization of Petroleum Exporting Countries and its allies, including Russia, known as OPEC Plus, agreed this week to lower their output by 2 million barrels per day. This comes ahead of a European Union embargo on Russian oil, which will squeeze supply even further in what is already a tight market. Brent crude was up 3.7% to $97.90 a barrel, whilst the US benchmark WTI, that's West Texas Intermediate, gained 4.7% to $92.63 per barrel. For the week, Brent was up about 10%, while WTI was up about 15%. Marban oil, which Kenya imports, increased to $95.21 per barrel compared to $88.54 the previous week. In the gold market, the price of gold fell on Friday after a better-than-expected U.S. jobs report cemented expectations that the Fed Reserve will continue to implement steep rate hikes, which lifted the dollar against gold. Spot gold was down 0.9% to $1,695 per ounce. The gold market is now focused on the key inflation data, which is due out this coming week. We now shift focus to the Kenyan market, and we start off as usual with exchange rates. During the week under review, the Kenya shilling remained stable against major international and regional currencies. The Kenya shilling was trading at 120.82 versus the US dollar, 137.49 against the sterling pound, and 119.92 versus the euro. And against the regional currencies, one Kenya shilling was exchanging for 31.66 Ugandan shillings, 19.30 Tanzanian shillings, and 8.81 Rwandese francs. On foreign exchange reserves, according to the Central Bank of Kenya, the usable foreign exchange reserves remained adequate at $7.321 billion, which is equivalent to 4.13 months of import cover. This is in line with the central bank's statutory requirement to maintain at least 4 months of import cover. However, we note that the foreign exchange reserves have been declining steadily from a peak of $8.81 billion that was recorded at the beginning of this year to the current levels, which is a decline of $1.49 billion in a period of just 9 months. In the money market, the liquidity situation in the interbank market improved, partly as a result of increased government payments, which helped to offset tax remittances. Commercial banks' excess reserves in relation to the 5.25% cash reserve requirement stood at 26.2 billion shillings. Open market operations remained active with the average interbank rate at 5.11% compared to 5.50% the previous week. During the week, the average value traded increased to 14.4 billion shillings from 10.9 billion shillings the previous week. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 6th of October, and the central bank received bids totaling 26.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance of 110%. Interest rates remained stable, with the 91-day rate increasing by 8.4 basis points to 9.036%. While the 182-day and the 364-day rates remained unchanged at 9.63% and 9.90% respectively. In the primary bond market, there was an auction on Wednesday, the 5th of October, for the reopened 10-year and 15-year fixed-rate Treasury bonds, and the central bank received bids totaling 18.8 billion shillings against an advertised amount of 40 billion shillings, representing a performance of 47%, but ended up accepting only 15.1 billion shillings. And the results of the auction were as follows. The first bond, FXD1/2017/10, with 4.9 years left to maturity, the central bank accepted 14.1 billion shillings at a weighted average rate of 13.369%. The second bond, that is FXD1/2020/15, with 12.3 years left to maturity, the central bank accepted just 1 billion shillings at a weighted average rate of 13.97%. For the month of October, the central bank is still looking to raise an additional 20 billion shillings from the sale of a fresh bond issue, that is FXD1/2022/25. That means it has 25 years to maturity and whose coupon will be market determined. This new bond is now open for sale until Tuesday, the 18th of October. At the Nairobi Securities Exchange during the week under review, the equities market was on a downward trajectory, with the NASI, the NSE 20 and the NSE 25 declining by 1.6%, 2.4% and 2.2% respectively. The market's performance was mainly driven by losses recorded by large cap stocks such as KCB Group, which fell by 4.5%, Absa Bank dropped by 4.4%, Equity Group lost 4.2%, and Bamburi declined by 4%. These losses were, however, mitigated by gains recorded by other large cap stocks such as NCBA Group, which rose by 5.4%. During the week, market capitalization declined by 4.2%, whilst equity turnover decreased by 2.2%. In related news, Safaricom Group PLC announced the official launch of Safaricom Telecommunications Ethiopia, an international consortium that will offer telecommunication services in Ethiopia. Another update from the telecom sector is that the Treasury has now repurchased a 60% stake in Telecom Kenya from the UK-based private equity fund Helios Investment Partners for about 6.1 billion shillings, reverting the company back to a fully state-owned enterprise. Looking at the economic calendar for this coming week, on Wednesday, the 12th of October, we are expecting minutes from the Federal Open Market Committee, which is the committee of the Federal Reserve that determines monetary policy for the United States. And investors will be looking at the content and the tone of the minutes for clues on policy outlook. On Thursday, the 13th of October, the U.S. Consumer Price Index will be released by the U.S. Department of Labor Statistics. The Consumer Price Index is a measure of inflation and looks at price changes for a representative basket of goods and services. On Friday, the 14th of October, U.S. retail sales data will be published by the U.S. Census Bureau. Retail sales is a leading indicator about consumer spending, which is significant because it contributes about 65% of the United States gross domestic product. And as we come to a close, we now look at the topical issue. And the topical issue this week is on the World Bank downgrading Kenya's growth outlook. The World Bank has downgraded Kenya's economic growth outlook for 2023 to 5%. This is on the back of concerns over rising commodity prices and the effects of the ongoing drought. The bank had earlier projected the country's growth rate at 5.5%, but that outlook has been dampened by high inflation rates as well as food insecurity that has hit the Horn of Africa. Adverse weather conditions have exacerbated inflationary pressures that were triggered by supply chain disruptions during COVID and currently by the ongoing war in Ukraine. The bank noted the slowdown in economic activity resulting from weaker demand and consumption associated with a contractionary monetary policy on the back of higher inflation. Kenya's inflation has risen to about 9.2% in the month of September, up from 5.4% at the beginning of the year, and is currently way above the central bank's upper limit of 7.5%. In related news, the World Bank has supported a push by emerging market countries to have their debts restructured. The reason for this being that emerging market countries are currently unable to access the international debt markets due to the high interest rates being demanded by foreign investors. In the Africa Pulse report, the World Bank has said that the debts of developing countries could escalate into a crisis if their governments are unable to service existing loans as they fall due. Kenya has been unable to tap the international debt markets since dollar interest rates for the country's Eurobonds have more than doubled from the previous issuances at around 6% to the current levels of above 12%. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast. We hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. We really do appreciate your assistance in this effort. For your information, in addition to our usual audio directories, that is Apple Podcast, Spotify, and Amazon Music, the Market Color podcast is now available on YouTube. Please subscribe and remember to turn on alerts to be notified of new episodes. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. And to all our listeners, we thank you for your continued support, and as usual, I look forward to interacting with you again next week. And until then, be the change that you wish to see. Thank you and God bless.